Welcome back. You're still watching Power Breakfast. Now on to the top economic headline. The Indian economy has contracted by nearly 24% in the first quarter as COVID-19 took a toll. This is the worst economic contraction on record and is even sharper than the CNBC-TV18 poll of the 20% drop. Latha is here with me in the studio to detail all of these numbers for us. Latha, this is much worse than the poll that even we were working with.
Yes, that's the ugliest part of the number. Otherwise, everyone was prepared for a contraction. But I might tell you that when things are so bleak, that it is slightly more bleak is not really like, things are coming down on you. And I want to put on board one thing. This is past data, okay? For me, the auto sales numbers are always more important because they're more forward-looking. But that said, the positive number really is the agri number, which has come in at 3.4%. Many people expected. Our poll itself said 4.8. So even the only growth number we got is not as good. So all this, rural economy is doing very well. Okay, it's not as great as people thought. And then, of course, there's the disaster. Manufacturing, minus 40%. Construction, minus 50%. Services, minus 47%. So, it's much worse than what people expected. The number that really took everyone's breath away was public administration. Now, in public administration, you have defense, schools. There it was expected to be positive because the government spent more. But even that has come at minus 10%. That's where all the economists got clean bowled, and that's why the numbers have come lower than their estimates. It looks like obviously all the construction work, all the capex that the government would have done has not been done. That is why it is lower than the previous year's number. Well, the bigger issue will be, you can read the same GDP from the expenditure side. This agriculture, industry, manufacturing is from the output side. If you look at it from expenditure side, consumption expenditure has contracted by 27%. Now, that's really where it hurts. Capital formation is down by 53%, but that's okay. No one expected that you will do capex when even what is being produced is not getting consumed. And government consumption has gone up by about 16%. That's the only thing that's working well. But this consumption of 27% contraction, if we are able to put that back on the table, things will be much better. So that's what people are really watching. The private final consumption expenditure number, minus 27, should come down to 0 by this quarter. Then we are really home.
All right, Latha, thanks a lot for detailing all of those numbers. But actually reacting to the GDP data, Chief Economic Advisor Krishnamurthy Subramaniam said that the GDP print was on expected lines given the global pandemic. However, he added that India is witnessing a V-shaped recovery since the economy is now unlocking.
This print is expected given the exogenous factor, the global pandemic that the entire world is going through. The April to June quarter was especially one where the entire global economy was in lockdown. The Indian economy also was in total lockdown with several restrictions placed on economic activity. So this is not entirely unexpected. India's lockdown was far more intense than that of other countries, and so the impact is something that is not unexpected. But in terms of the outlook going forward, what we are actually witnessing as the economy has been unlocked has been a V-shaped recovery.
All right, the Chief Economic Advisor Krishnamurthy Subramaniam, they're sounding quite optimistic. He's saying that ever since June, we have been seeing quite a V-shaped recovery now that we have been unlocking. But Latha is still with us right now, and the Reserve Bank has announced more Operation Twist, term repo operations of 1 lakh crores. It has also increased the amount of bonds that can be held to maturity. Latha, take us through the key details of the measures that the RBI has undertaken.
Okay, well, just a word on this V-shaped. When you are minus 24 and you get to minus 7, say, in the current quarter, it is a V. But is it V enough to take us to positive terrain is the question we have to ask, and only time will tell. To speak about the measures taken by the Reserve Bank, the bond markets were kind of thrown off guard by the higher inflation number. Then the MPC minutes were hawkish. So feeling that there are no more rate cuts had pushed yields up from 5.75 in the first day of August to about 6/4 almost. That is a 40-50 basis point increase in yields as data came in after the second half of the month. Now what the RBI has done is threefold. It's almost as big as a monetary policy. The one thing they did is to announce another Operation Twist. What is an Operation Twist? It's just jargon for RBI buying longer term bonds, selling 1-year paper. There's a lot of demand for bonds that will mature in 6 months, 3 months, 9 months. So they're selling that from the kitty and buying longer term bonds for which there's very little demand. Now the 10-year I'm talking about, for that they're creating demand. They're going to do that 10,000 crore on 10 September and 10,000 crore on 15 September. The second thing they're doing is they're going to increase the amount of bonds that banks can buy but don't have to mark to market. Now, one of the reasons why there is less appetite for bonds is that you buy and then because of some inflation number bond prices fall, you have to provide for it in the P&L. So banks are refusing to buy. Now, what RBI is saying is at the moment 18% of the total amount of bonds of your total deposits can be invested in bonds which you don't have to mark to market. You say, I'm holding it to maturity. Why should I mark to market? That 18 is becoming 22. You can buy and you don't have to mark to market. That makes about 5.7 lakh crore of bonds. Extremely bullish. And finally, they have said that originally they had given those LTROs, long-term repo money. At that time, banks, the prevailing interest rate was 5%, 5.1%. Banks had borrowed that money. And before you realize, in about 3-4 months, the repo rate had fallen to 4%, and actual interbank money was exchanging hands at 3.3%. There was so much liquidity. So banks were just sitting with that 5%, which was expensive money for them. Now RBI is saying you can return that money to us in advance before the period of 3 years or 2 years ends, and you can borrow fresh money. Or in sometime around mid-September, about 1 lakh crore will be made available. Now, this could mean a bit of liquidity tightening because people could return the money and not borrow fresh because there's too much liquidity. But we don't know how it will play. The rules are not in. Basically, the idea is to reduce the cost of borrowing for banks so that they will go out and lend cheap.
All right, Latha, thanks a lot for that. Experts expecting bond prices to see a huge surge today. So we will, of course, watch out for that as well. So let's slip into a short break. On that note, we will come back and get you some more top stories today.